And we've been calling, and we even got, believe it or not, quoted in the Jerusalem Post for saying $333 for silver. Now, we have an interim target level that is generated from natural geometry as per a method that is usually very well respected at the $90.56. So that means you run 90.56 and then you chop and churn potentially for a little period. It's not if, but when. And it goes actually, in our view, likely into 4 digits and single-digit gold-silver ratio. Gold-silver ratio drops to below the 10 mark, brought down to the level that it's mined. At current levels, it would be 6.9. What is happening in the rest of the world, not gold and silver? I would say in silver, there is a bit of fundamental shortfall driving the silver price additionally, which will be the catch-up. What you're seeing is debt and fiat balances being rotated out into gold ounces, and even more so with the fundamental squeeze on supply. Silver ounces, silver is the more known and the more regularly followed market, and it's absolutely ripping. The only people this is probably not coming as a surprise to is us, because we've been the biggest bulls in the house. We've warned everybody that you're actually in terms of, and I respect you don't want charts, and we did a very chart intensive presentation last time, so I have to just describe this visually very shortly and clearly. You've been in a macro structure that's essentially spanned the 60s to the run up in 80. So literally my entire lifespan. I was born in 68. The whole Vietnam War, debasement, hyperstagflation that saw the 80 run up, right the way through to roughly November 24, when silver triggered on a primer. We have a squeeze within a squeeze. So HVF method, our methodology trades constriction with a massive expansionary move with a very tight stop. We've been in a quarterly, that's a 3-monthly mega structure that spans that entire lifespan of myself. You can even go back to 64 and the run up into the 80, that whole setup right the way to 24. So you're counting 40, a 60-year structure set up. And then within that, we had a squeeze within a squeeze, which is the primer that gave us very tight entries at 25.9. And we've been calling, and we even got, believe it or not, quoted in the Jerusalem Post for saying $333 for silver. Now,
Silver's move didn't start this year. It's the release of pressure built across 6 decades. What Francis Hunt is describing is a generational compression structure, not a short-term trade, spanning from the 1960s inflation cycle through the 1980 blow-off and into today. As Francis Hunt has outlined before, multi-decade volatility squeezes tend to resolve violently, not gradually. Silver breaking above $25 wasn't random. It aligned with macro liquidity stress and real rate compression. When long-term structures break, price discovery accelerates faster than most models allow. What comes next matters even more than how we got here.
Now, that was about 6 months ago. That was a crazy thing to say 6 months ago. A lot fundamentally has happened recently. That makes it sound a little less crazy, and a lot technically has happened, and we've gone from that 25.9. It coincided with my friend Brent Johnson saying, here goes the silver guys losing their head because they're crossing $25 for, its annual pilgrimage and round trip back. He literally called the primer break as it was starting that journey. It went up, it broke 30, 40, 50, 60, and here we are at 70. Unsurprised, benefiting immensely, our community benefiting immensely. Precious metals, hyperstagflation is the model, economic model, and this continues to run and surprise people. We have a pause, but your question was around the 3-digit marks, so let's answer that. We have an interim target level that is generated from natural geometry as per a method that is usually very well respected at the $90.56. So that means you run 90.56 and then you chop and churn potentially for a little period. So you've still got potentially quite a bit more brisk upside before you run 90. And the interim levels are usually beaten. So to beat it by 10% will bring you to the threshold of triple digits before you might get a bit of rejection.
Markets ridicule big calls right before validating them. Francis Hunt says 6 months ago, 333 silver sounded absurd. Today, silver is up nearly 170% from the $25 area, while inflation-adjusted real rates remain negative. Brent Johnson's skepticism mirrors a common analyst error, anchoring to past failed breakouts instead of structural regime shifts. The $90 level isn't hype. It's a measured interim target rooted in long-term geometry and volatility expansion. Historically, metals overshoot technical levels by 10 to 15% during momentum phases. Next, Francis Hunt discusses the real test isn't whether silver hits triple digits. It's how investors react when it does.
So I think the interplay with triple digits and silver is going to be where you might have quite volatile moments. Until then, you want to stay aggressively and broadly long. You want to continue to be a stacker as an investor. And as HVF method trader, we continue to turn our profits into new entries on smaller time frames. And I've just got entries, and the stops are all trailed now, mostly into profits, and apart from the very recent ones of the last week or so. And it just continues to reward us. So we're sitting at all-time highs. Triple digits will happen as far as I'm concerned. There may be some reaction during that period, and then we go 333. That's not the top. It's our final target for the position, but it doesn't mean it's the top because it's a secular blow-off market. So we'd probably reduce by about 40-50% our positions and then revert to overperformance management. So we expect the structure to overperform because it's a macro setup. We treat it as a first in a new trend. So blow off numbers to 1,000. I will utilize, because the next question is, when do you ever sell? Because you sound like such a bull. When we go single digit on the gold silver ratio. I'll flip back into gold and or other assets that will be relatively cheap, which could be property, farmland, agri, other areas of interest, stocks potentially as well. So that's your answer to your question regarding triple digits. It's not if, but when, and it goes actually, in our view, likely into 4 digits and single digit gold silver ratio.
This isn't about being bullish, it's about managing a secular regime shift. Francis Hunt is outlining something most investors ignore. Volatility doesn't invalidate a trend, it confirms it. During past blow-off phases, like 1979 to 1980, metals saw violent pullbacks inside explosive moves. A single-digit gold-silver ratio has only occurred during extreme monetary stress, and today's global debt exceeds $310 trillion. Profit-taking isn't panic selling, it's strategic rotation. Next, Francis Hunt talks. What matters next is when capital starts fleeing into real assets outside metals.
Do you really see gold to silver ratio dropping that much?
So currently, in terms of mining rates, I want to shout out to Silver Guru. I think it's Dave Morgan. He was highlighting production and mining and how it was around 9.3 ounces of gold. I think it was 2019. None of these numbers I've remembered exactly, so just get the trend. 2020, it was about 9.1, 8.6, 8.3, 7.9. You're now at about 6.9 ounces of silver. The last known year, I think it was 24. We obviously won't have the numbers yet for 25. 24 finished in 6.9 ounces of silver are being pulled out the ground for every ounce of gold. Also, silver is being consumed, as you know, industrially, while the gold is either stored as bullion and can be brought as float back into the market at prices very, very easily. Now, silver also has bullion, but it has a much higher industrial burn of use case. Some of that is recovered, but it's costly. Some of that is not recovered because it's non-financially economic. I don't think that stays the way for too much longer. And the other key aspect about silver is that it's not being pulled out the ground by that many dedicated miners. It's a secondary product for many people, and that means you can't just up production because it's random.
The gold-silver ratio isn't a sentiment tool. It's a supply reality check. Mining data shows silver output per ounce of gold has fallen from over 9 to under 7 in just 5 years, while industrial demand keeps rising. Gold sits mostly idle in vaults. Silver gets burned into solar panels, electronics, and infrastructure. As Francis Hunt has pointed out, silver isn't mined, it's accidentally produced. That limits supply response even at higher prices. And that structural imbalance is why this ratio matters, far more than headlines admit.
It's people who's digging a hole for copper. It's people who are digging a hole for iron ore, for gold and other things, because it's been so uneconomic. It is the most mispriced metal to mine exclusively for silver, that you have to have such good seams to be a dedicated silver miner. There's not a trillion market cap for silver miners, even, not even close. And there's not that many dedicated silver miners. You could shout them all out on a list, and you wouldn't have a long list, and you wouldn't have a particularly big conjoined market cap. So in terms of suddenly switching on, now that most above ground silver is being absorbed and taken out of the market, it's not something people are going to be able to do. And yes, if that's the mining ratio, I actually don't think it's outlandish to think gold-silver ratio drops to below the 10 mark, into a number below that. In fact, if it was brought down to the level that it's mined, at current levels, it would be 6.9.
The silver market looks liquid on paper, but structurally it's closer to a supply dead end. Most silver isn't mined intentionally. It's a byproduct of copper, zinc, and gold operations, which means higher prices don't instantly create new supply. As analysts like Francis Hunt have highlighted, there are fewer than a dozen meaningful primary silver miners, and their combined market cap is tiny compared to gold producers. When above ground inventory gets absorbed, there's no quick switch to flip. If mining ratios are already near 6.9 to 1, a sub-10 gold-silver ratio isn't extreme. It's arithmetic catching up to reality. Next, Francis Hunt talks. The coming risk isn't price spikes. It's investors realizing supply can't respond.
Now, obviously, as price fixes things, as prices increasing, more shafts will open again that might have been mothballed, that were non-economic, and supply will increase. But I still see that there's a realistic chance of single digits. If you think I'm too aggressive, go with 20 or 15 if you like. You will have done exceedingly well. We're still in the 60s right now. I'd have to check to give you an exact number.
64 or 63 today.
Yeah. Let's just do that for you, and I'll give you an idea. Gold-silver ratio currently at 63.076. And we expected this degree of chop at the 65, by the way. Again, if we do a chart share another time, I can show everybody this, but we've spoken about the macro and 65. So we had a little bit of a dip down to sub 63. We rallied back up to 65. Gold was a little bit stronger. Silver had a little bit of a pullback. We made a new low, and now it looks like we might be rallying back up in the direction of 65. I'm not sure we're going to get there again. So you've got a lot of a multiple. If you think 20 and we're still north of 60, you've got outperformance by silver 3 times to gold, which is going up pretty damn decently itself.
This isn't about calling the exact bottom. It's about understanding the asymmetry. Even a conservative move in the gold-silver ratio from the low 60s to 20 implies triple the relative upside for silver without requiring gold to fail. Historically, major ratio compressions didn't happen smoothly. They chopped, faked out traders, and punished late momentum chasers. The 65 level he references aligns with prior macro inflection zones seen in 2003 and 2010. For long-term investors, this setup isn't reckless. It's risk-weighted positioning, where downside is limited relative to upside. Francis Hunt discusses what matters next is how quickly patience gets rewarded.
Don't forget, it's on a 70%, 68 to 70% return for this year itself. But if I tell you gold's going to continue to do that, and by the way, silver, you think it will go 20, you think I'm a bit too aggressive at single digits, well, you're talking about a 3x overperformance for silver next year to gold. And what people don't realize is they think it can't move that fast. The problem people don't see is how big the debt and fiat system truly is, and how perilously it's in the suddenly very quickly phase of the Ernest Hemingway bankruptcy curve, slowly at first and suddenly very quickly. So fiat and debt debasement is huge. It wouldn't shock me that governments are issuing currency and now trying to buy back metals in multitudes of ways themselves to try pursue sound money principles at the last moment, which they haven't been doing. But it started with China. It started with the East. You've always had more aggressive accumulation, and that's not a new phenomenon. It's come out of the 70s from the Vietnam War side. If you just had silver on the Asian sessions, we would be incredibly higher already. We would be deep in triple digits already. It was the Western world, the Western axis that had been selling it off and keeping the discount window open, all while inflationary policies were being pursued, excess government expenditure to income was being pursued.
Silver's speed isn't the risk. The debt system behind it is. Global debt now exceeds $310 trillion, and history shows monetary regimes don't unwind gradually once confidence breaks. As Francis Hunt warned, collapse comes slowly, then suddenly, and metals tend to reprice faster than investors expect. Eastern central banks, led by China, have been net buyers of gold for over a decade, while Western markets suppressed price discovery through paper selling. If silver traded purely on physical demand, Asian sessions alone would tell a very different story. The real shock will be when Western selling pressure disappears.
Nefarious projects of enrichment, cacocracy and corruption was being pursued, etc., etc. So all sorts of it. You've got Billy Graham being pulled out for getting kickbacks from Ukraine money that's being sent over. They're all in it. These people cheat. You're the only honest player at the poker table. You're getting skinned alive. It's time you recognize the extractors work against you. They steal from you, and you need to protect yourself from their nefarious activities. Get out of their monkey money and their debt.
Yes. Francis, what dangers arise from excessively high gold and silver prices, such as potential market instability or increased scrutiny? Is there any danger of that?
Let me reframe the question. What is happening in the rest of the world, not gold and silver, that's leading the truth thermometer telling you how hot it's getting in the sauna because of those things in the rest of the world? It's not so much, I would say in silver, there is a bit of fundamental shortfall driving the silver price additionally, which will be the catch-up. But if you take gold, which is pretty well supplied, why is its price running like it is? It's because it's telling you, it's the thermometer in the sauna that said someone snuck in there and has turned up the heat and everybody's sweating. It's not the problem. It's not the cause of the problem. It's the thermometer that's telling you there's a problem. The problem is the fiat and debt market. It's not the gold price.
High metal prices don't destabilize markets. They expose what already is. Gold isn't causing stress. It's measuring it, much like bond yields did before prior crises. Despite ample gold supply, prices surge because confidence in fiat systems is eroding, driven by deficits, monetization, and political extraction. Central banks didn't suddenly become reckless buyers. They're reacting to risk they won't publicly admit. Silver's added supply shortfall only accelerates the signal. When the thermometer rises, smashing it doesn't cool the room. Next, Francis Hunt talks. What comes ahead is whether investors heed the warning or ignore it again.
It's the dollar debasement. It's the fiat and debt debasement. Fiat and debt are the same thing. Debt is just postponed fiat with a rental agreement attached to it, known as a usury extraction or rental extraction by form of an interest payment yield. And we are at the whim of a Pharisees-based system that is essentially a borrowing. You know, usury is banned in the Muslim faith. and it was frowned upon. Jesus was only violent once in the Bible, and he overturned the moneylender's table. You are in a system run by the Pharisees. This is fiat and debt debasement due to overproliferation, and they are taking the money they steal and they are buying hard physical assets. But because it's a crisis of unit of account, the most valuable assets to buy that will perform best are the monetary assets of preservation of value. So we've coined the phrase, this is the rotation to preservation. And what you're seeing is debt and fiat balances being rotated out into gold ounces, and even more so with the fundamental squeeze on supply, silver ounces, and can I say platinum ounces, which is an even more scarce metal than all of them, and industrially very unique, although not monetized to the same degree as gold or silver.
This isn't a currency debate. It's a quiet admission that the unit of measurement itself is failing. Global debt has crossed $310 trillion, and servicing costs alone are now growing faster than GDP in most developed economies, which turns money into a shrinking claim over time. As Francis Hunt often notes, when the unit of account breaks, capital doesn't chase yield, it seeks survival. That's why central banks continue accumulating gold, even while publicly dismissing it. Silver and platinum amplify this shift because supply constraints collide with monetary demand. Next, Francis Hunt explains why gold isn't rising. It's revealing damage already done.
So when you ask the question, gold price, what it actually is doing is the gold doesn't change. It just tells you the truth. It's the thermometer on the wall. It's always on the wall. It tells you the temperature. The temperature is the time left for a debt and fiat-based crash that is actually in a huge debasement. And the harder it falls, the plane that always holds its altitude looks like it's going up because it's going up in monkey money. And that's how you should always view it.
So it is a truth metal. I agree, definitely.
Yeah, it's a truth metal. It's 100%. And if you talk about our channel and my profile, I am absolutely fanatical about what is the truth of the matter. No matter how dark, I can handle it. I want to know it, and I will take action according to that. Gold is the friend of people of principle, sound monies, principles, and people of character and integrity. And it shows up the fraudulence of systems that lack those three things. And that is where we are. And it's not a linear thing. They get away with the stealing for a long, long time with the dilution until suddenly they get found out.
Gold isn't appreciating. The measuring stick is shrinking. When currencies debase, assets priced in them appear to rise, even if their real value is unchanged, which is why gold behaves more like a diagnostic tool than an investment. Historical data shows gold spikes align with loss of confidence, not growth cycles. 1971, 2008, and post-2020 all confirm this. As Francis Hunt emphasizes, trust erosion isn't linear. It's tolerated until it suddenly isn't. Investors who mistake this signal for speculation miss its real function, revealing systemic stress early. Next comes why that stress doesn't unwind gradually.
So instead of at the rate that they are proliferating, you get this, it actually looks like they're getting away with it. You get propaganda covering up, but then suddenly trust disappears. The trust curve is not a linear 45-degree downward line. It's people keep hoping that you'll become honest and be good. They vote for hope and change every time, from red to blue and back again, until suddenly they realize they keep getting the same old boss regardless. The new boss, same as the old boss, as the Who used to sing in their songs. And then everybody realized the interest payments can't be afforded. Mathematically, the game is up. And that's when you get this. So in actual fact, by living in these times, you get all the compressed, hidden, manipulated value of gold and silver being re-rated violently, all in your favor, when that should have been evenly distributed over the last years since 64. So you are going to be around for the catch-up phase, and that's why it's going to melt faces that people haven't truly officially fully understood. You're in a face-melting move where everything gets found out that deserves to be found out, everything fraudulent. This is a great financial truth moment.
Trust doesn't fade, it collapses. History shows confidence breaks suddenly when math overwhelms narratives, and dead interest costs are now doing exactly that across governments. The illusion of stability is maintained through media framing and political cycles, but cash flow reality eventually wins. Gold and silver didn't steadily reflect this since 1964. Suppression delayed repricing, creating today's compression effect. For investors, this isn't about timing panic. It's about recognizing the catch-up phases are violent by nature.